Okay, so the financial statements essentially come from this equation, okay? The the name of these financial statements is actually important. It's at the end of the semester, I had students that didn't know the names of these. If you're going to work in these professions, you got to know the names of these financial statements, okay? Income statement. This is basically this bottom part here. We're going to traverse up this tree because at the end we want to prove to our financial statement readers that assets equals liabilities plus equity at the end of the period. Just like we did, I just showed you that addition of the both sides. We're going to want to prove that to our financial statement readers. So we're going to start with the bottom here. Revenues minus expenses. In a year, in a quarter, we're going to list all of the revenues, all the expenses, and we're going to show how much profit we made in that period. Okay, so that's going to get us part of the way to figure out what our equity balance is. Okay, so this first financial statement is called the income statement. It's just going to list all your revenues, it's going to list all your expenses, and it's going to show what your total earnings were for that period. Okay, it's usually a quarter or a year. And if it's an annual income statement, it's going to be for 12 months. If it's a quarterly income statement, it's going to show what happened in the last 3 months. So now that we now have our net income, as it's called. This is how much profit we earned. We now want to see what our retained earnings is, right? So we take the number that we just got from that income statement, that profit, and we see how much we paid in dividends. Okay, so we're going to have basically a retained earnings balance at the start of the year. We're going to see how much profit we generated in that year, which is this. We're going to subtract how much dividends we paid, and we're going to get an ending balance for retained earnings. Okay, so this framework is going to be, we're going to see this framework of beginning balance plus additions minus subtractions is going to give us our ending balance. Okay, so we're going to see this with inventory, right? We started with some amount of inventory, we bought more inventory, we sold some inventory, and then we have the ending balance. For retained earnings, we have a beginning balance. At the beginning of the year, we had some amount of retained earnings. We then added our net income. We're subtracting dividends, and that's going to give us our ending balance for retained earnings. Okay, so we're going to have one financial statement that's just kind of devoted to this. Okay, and that's going to show us this ending balance for retained earnings. Okay, so we're going to look at some real financial statements later. But really, this statement of retained earnings is like, it's not really a real one that's presented, but for your book, because they want you to kind of step through things individually, we have the statement of retained earnings. So now we have this part of equity, okay? After this statement of retained earnings, we now have the retained earnings balance for our company. Now we're going to go to the next part where we combine our retained earnings with how much contributed capital there is, and that's going to give us the total equity balance. Okay, now we have this green, we have the amount that we're going to put here. Okay, now we've gone through, we start with the profit, we added the dividend piece, we added the contributed capital piece, and now we have the total equity balance. Okay, and that there's a lot of complexity in this. But if you're like an owner of a company, that's really what you care about, right? How much your company, how much your ownership stake is worth. So this is a statement of shareholders' equity. It's going to give you basically the ending equity balance. And then the main financial statement is called the balance sheet. The balance sheet is going to show all your assets, and it's going to show that that equals liabilities plus equity. It's going to show that this balance is maintained as of the end of the year. Okay? And we went through all the rigmarole to figure out what this balance is. right? All those other financial statements were leading up to getting this. Once we have this, we can complete the balance sheet. Okay, last one. These are all interrelated, okay? Your income statement, revenues minus expenses gives you the net income. The net income feeds into the statement of retained earnings because you have the beginning balance plus this minus your dividends gives you this. This ending retained earnings balance is going to flow into the balance sheet. So they're all building on each other. Okay, is that clear? Okay, so now let's see this in a real company. Okay, so this is Google, okay? So let's start at the bottom. So they call it the income statement. They're calling it the statement of income, okay? It's saying the same thing though, okay? So you can see here their net income. So they have their revenues. Okay, so they're listing their revenues 200 in this last year 350 billion, okay? This is in millions of dollars and it's for the year it's for the entire year of 2024. So 350 billion is their revenues. They have a bunch of their expenses listed. Income tax, they step down and they basically get to their profit of $100 billion for this year. Okay. Now, if we go look at this statement of shareholders' equity, okay, you're going to have the beginning balance. So at the end of 23 is the same as the beginning of 24. Okay. So this line right here is the beginning balance. Okay. And if you look here, retained earnings right here, this column this is all of their different equity accounts. But if we just look at retained earnings, this is what their starting balance was. You can see that the net income is added in here, this 100 billion. They also paid dividends, essentially. So they have some dividends that they paid as cash. They also, and we're going to learn about this later in chapter 13, they also returned money to the shareholders by repurchasing their stock. It's essentially another form of dividend. Okay, so they have beginning balance minus their dividends, you can say, plus their net income. And this is the ending balance of retained earnings. And then they have, these class A, class B, class C. This is all contributed capital. Okay, so this statement is showing all contributed capital, retained earnings, and it's giving a final total stockholder equity ending balance here. So remember this 325 billion, okay? Because we're going to need this in our balance sheet. This is the total equity. Okay, so if we go here to the balance sheet, this is the consolidated balance sheet. So it has all their assets. They got cash, accounts receivable, property, plant and equipment. So they have 450 billion of assets, and they have liabilities, accounts payable, deferred revenue, which is essentially unearned revenue. They have debt. They've borrowed money. And then at the end here, we have this total equity of 325 billion. And you can see here that their total liabilities and equity, 450 billion, 256, is equal to their total assets, 450 billion, 256. Okay? So this accounting equation is represented right here. And I just stepped through it. I did it quickly, but I just wanted to show you that this is how it works, It's much more complicated. They have way more accounts. If you want to know the details, you have to read all 75 pages of this to understand the details of all these numbers. But essentially, it's all built on this framework of assets equals liabilities plus equity.